Hello everyone. In this video, I'll be discussing about decentralized exchanges. But before that, let's talk about how exchanging of assets started. Barter systems were the earliest forms of trade that involved a direct exchange of goods for goods between individuals, but this system had its own limitations, like it was difficult to assess fair value, it was necessary for both the parties to want what the other had to offer. Apart from this, there was a lack of a centralized medium of exchange as well. Now, as trade became more complex, the concept of money came into being as a widely accepted medium of exchange, which is why it was considered as a convenient method of conducting transactions. As societies continued to grow and trade expanded, the need for a more organized and efficient way to facilitate transactions became apparent. So, this is how exchanges were created. Through exchanges, buyers and sellers were able to discover fair market prices and execute transactions in a more secure as well as a regulated environment. Now, let's dive into how these exchanges make sure deals are fair as well as organized. One key tool they use is called an order book. So, order books are a list of buying and selling orders. It does not only include the price at which a seller is ready to sell or a buyer is willing to purchase at. Rather, it also includes details about the quantity of tokens and the type of tokens to be traded. These exchanges don't actually possess the assets that are being traded. Instead, they act as a matchmaking service by pairing interested buyers and sellers together. So, for example, I want to buy one Bitcoin at $30,000 and you are selling it at the same price. Then only the order will be executed because there is a match. Lastly, order books do provide transparency in the sense that they allow traders to see the supply and demand dynamics so that they can make better decisions. But with order books, there can be cases of manipulation as well. Like traders could make use of trading bots to create the impression that there is a high buying or selling pressure for a cryptocurrency by placing several large orders without actually intending to trade. So, this diagram shows us a realistic picture of how order books function. So, as you can see, a list of people selling and another list of those looking to buy, showing the volume and prices they're willing to trade at. So when someone wants to sell 220 tokens at $100 and there's a buyer ready to snatch it up at the same price, then only the order will be executed. So here are some examples of centralized exchanges like Nasdaq, Toronto Stock Exchange and London Stock Exchange. It's where buyers as well as the sellers they come together to trade stocks. These are some examples of popular centralized exchanges dealing with cryptocurrency like Binance, Coinbase, Kraken. Apart from these, Gemini and Bitstamp are other centralized exchanges as well. These platforms act as intermediaries that allow users to trade various cryptocurrencies. So, now that we are familiar with centralized exchanges where people actually set the prices, let's have a look at what happens in decentralized exchanges. So, they use automated market makers where there's no need for people to decide the prices. AMM is a type of DEX protocol which makes use of a mathematical formula and smart contracts as well to determine prices of assets which are to be traded. The way it works is that it adjusts the prices depending on how many people are trading. So, for example, if a lot of people want a particular digital asset, the smart contract might increase its price a bit. If fewer people are interested, the price might decrease. Instead of matching buyers and sellers, an AMM relies on liquidity pools. So, liquidity pool is like a pool of funds where the contributions are made by users who are called liquidity providers. And each pool usually contains two assets, and the ratio of these assets determines the price. But if you look at AMMs, there is always a risk of impermanent loss, which occurs when the value of the two assets in the liquidity pool changes. So this risk is usually higher when we're talking about volatile assets, and liquidity providers can incur losses if the value of the two assets changes during the time their funds are locked in the liquidity pool. How do AMMs work? So, for example, if you have a pool with token A and token B, the smart contract will calculate the price based on the proportion of these two assets in the pool, which is done using a mathematical formula. And the smart contract will then tell the trader at what price can they exchange token A for token B. Moving on to the benefits of using AMMs. So, AMMs ensure that there is a consistent flow of liquidity in the market. Liquidity means there's enough trading activity so that it's easier for traders to buy or sell assets without significantly affecting prices. In AMMs, prices are always available because of the automated algorithms that adjust them based on the assets available in the liquidity pool. Unlike traditional trading, which is often limited to specific operating hours, AMMs operate 24/7. So, this basically means that traders can exchange assets at any time, day or night. Other than that, anyone can participate by adding their assets to the liquidity pool, becoming a liquidity provider. By doing so, they not only contribute to the liquidity of the market but also earn fees. There are several types of AMMs, each with their own unique features and characteristics. These three are the most common types of AMMs: constant product, constant sum, and hybrid AMMs. The most common mathematical formula used in AMMs is the constant product formula. So this is basically the formula, as you can see: x into y is equals to k. So x and y, they denote the quantity of tokens, and k suggests that the product of the quantity of each asset in the pool, it will remain constant, which is why it's called the constant product formula. Now this formula, it's used in Uniswap, which is one of the most popular AMMs. Let's take an example to better understand this. So let's imagine that we have two tokens A and B in a constant product AMM. At the start, we have 100 tokens of A. Let's call it X is equals to 100, and 100 tokens of B. Let's denote it as Y. So now you can see that there's a ratio of 100 is to 100. Now there is a rule in this system that the product of the reserves has to always stay the same, which is K. So K has to be 10,000 always. So if someone decides to buy 50 tokens of A, so the new amount of A becomes 50 because we subtract 50 from the initial 100. In order to keep the product constant, the amount of B needs to change. So using its mathematical formula, let's say it would be 50 into y is equals to 10,000. This way we will be able to figure out the amount of b which needs to be 200. So now the ratio would be 50 is to 200 instead of 100 is to 100. Now that we've explored the constant product formula and its application, let's talk about some of the limitations that come with using this approach. Firstly, capital inefficiency. Now, this happens because the liquidity, or you can say the availability of assets for trading, it's evenly spread across the entire price curve. As a result, a portion of the provided capital might not be actively utilized, which would lead to inefficient use of resources. Secondly, slippage. So, this basically refers to the difference between the expected price of a trade and the actual executed price. Now, because of its fixed price curve, it can cause the price to change as the trade size increases, which results in less favorable deals for traders. Lastly, limited customization. So, traders can find it challenging to customize their participation in the liquidity pool according to specific preferences or even market conditions because its simple formula is x into y is equals to k. In a constant sum AMM, the sum of the quantity of the two assets in a liquidity pool remains constant. So when a user wants to trade one token for another, they deposit one token into the pool and receive the other token in return. The price of each token is determined by the ratio of the number of tokens in the pool as well as the sum of the tokens in the pool. Constant sum AMMs are less popular than constant product ones, but they have been implemented in several DEXs, including Shell protocol. Lastly, we have hybrid AMMs, which is like a mix of two AMMs, constant product and constant sum. So they allow liquidity providers to set the parameters of the pool. The price of each token depends on two things. First, it looks at how many tokens are in the pool, and second, it checks the total sum of all the tokens in the pool. So it's like a combination of quantity and total value. These are less common than constant product AMMs, but they have been implemented in several DEXs like Curve and even Bancor. Curve uses a hybrid AMM system, which is called constant function market maker. And this is the formula x into y is equals to a square. So in this formula, x and y, they represent the quantities of two different stable coins in the pool. A is a constant and its value is determined by the initial state of the pool. Now, the CFMM model, it aims to maintain a stable exchange rate between different stablecoins in the pool. As trades occur, the product X into Y stays constant so that it ensures that the market price remains close to the pegged value. Curve majorly focuses on trading of stablecoins. Stablecoins are such assets whose value remains stable because it's pegged to fiat currencies like US dollar. And these are some examples of stable coins which are traded on Curve like USDC, USDT, DAI. And this way, they're able to mitigate risk, which usually exists when we talk about volatile assets like ETH or Bitcoin. Using this approach, Curve is able to provide a focused user experience, especially for those who are looking for a stable trading environment with minimal slippage and fees. What makes Balancer different is its smart pools. They make use of a constant mean formula. Its formula is x into y into z, one third is equals to k. So x, y, and z represent the weights of the three assets in the pool. K is a constant value that remains unchanged, requiring the weights to adjust to maintain the equation's balance. Now, the CMMM formula basically allows Balancer to handle pools which have more than two assets in it. Let's try to understand what are some of the benefits of using this formula. Firstly, we have diversification of assets. So, this means that you can bring together different kinds of assets, not just one type. For example, you could mix various cryptocurrencies or tokens in a single pool. Dynamic asset balancing. It adjusts the weights of assets in the pool. If one asset becomes more popular or valuable, the system rebalances to maintain an overall constant mean to ensure fairness as well as stability. Next, we have reduced impermanent loss. So, impermanent loss happens when the value of your assets changes compared to just holding them. So, this way, it helps to protect your assets from losing too much value, especially when the market goes through fluctuations. Lastly, flexibility in pool composition. So, this gives you control over your asset pool. You can then decide which assets you want to include and also in what proportion. There are different types of pools that Balancer offers, one of which is weighted pools. So, we've seen that in traditional liquidity pools like those found in AMM such as Uniswap or SushiSwap, there are usually two tokens with equal weighting, that is 50s to 50. But weighted pools, on the other hand, it allows for a more flexible allocation of assets. For example, you might have a pool with three tokens and their weights could be 30%, 50%, and 20%. Then we have composable stable pools. So, stable coins, which are cryptocurrencies pegged to the value of traditional fiat currencies, so, in these pools, they aim to maintain stability and low slippage in trading pairs, just like we saw in Curve. Lastly, liquidity bootstrapping pools. So, this is where the owner of the pool has control over the dynamics and they can change token weightings over time. This feature allows for more flexibility in adapting to market conditions or even project requirements. Now, order books and AMMs, the both of them, they're different due to a number of reasons. Firstly, the pricing mechanism. In the case of order books, the price is set by the buyers and the sellers, but in AMMs, it's automatically determined by a mathematical formula based on the type of AMM which is being used by the DEX protocol. Then we have liquidity providers. So in order books, the liquidity providers are the ones who place the orders, but in AMMs, they are the ones who contribute funds in liquidity pools and receive fees for doing so. Next, we have order execution. So orders are executed when buy and sell orders match in the case of order books. But in AMMs, you don't need to wait for an order to match. Like you can easily trade index through liquidity pools. Transaction fees. So centralized exchanges, they charge fees for using their platform to exchange assets, but in DEX, usually users are charged a fixed percentage of fees, which is distributed among all the liquidity providers. Lastly, we have regulation and compliance. So, in centralized exchanges where order books are used, there are regulatory bodies governing these platforms. They also ask for certain documentation and details for verification purpose at the time of signing up on these platforms. But in the case of DEX, you just need a wallet address to trade assets as it makes use of blockchain technology. So, like all the data is readily available on the blockchain. So, there are no intermediaries governing the system. Lastly, we have concentrated liquidity. In traditional AMMs, people deposit two tokens in equal value to create a liquidity pool. And then this pool is used to facilitate trading between those two tokens by spreading it evenly across all possible prices, which also causes impermanent loss, as we saw. But now, in the case of concentrated liquidity, people can choose a specific price range where they want to provide liquidity instead of spreading it evenly across all possible prices. So, in this way, it helps people get more out of their money by allowing them to focus their liquidity where it's needed most. This helps to reduce your risks and also provide a better trading experience for users. Let's take an example to better understand this concept. So here we have Alice, Bob, and Carlos, and they want to provide liquidity to an ETH and USDC pool using a concentrated liquidity AMM. Now, for that, they each have an equal amount of ETH and USDC but want to deposit their funds over different price ranges. Now, ETH and USDC pool has separate areas of concentrated liquidity. As long as the price of each stays within their chosen ranges, then their funds will be actively used to facilitate trades. But if the price moves outside of their chosen ranges, then their liquidity will not be used and they won't be able to earn fees from trades which are happening outside their specified price ranges. So, by focusing their liquidity on narrower price ranges, the three of them can provide more support for the market within these ranges. So, that's all for this video. Stay tuned for the next one. Thanks for watching.